China's digital yuan just solved America's $318 trillion debt nightmare. Don't panic yet. $318 trillion. That's not America's official debt. That's the real number. And for the first time in modern history, someone found a way out. But it wasn't Washington. It wasn't Wall Street. It was Beijing. While economists were screaming about collapse, China quietly built something else. A digital currency that doesn't compete with the dollar. It does something far more dangerous. It makes America's debt manageable. Sounds like good news? Here's what they're not telling you. Welcome to John A.G., your analyst for the stories Wall Street doesn't want decoded. Now, if you've been following markets longer than most of these young traders have been alive, you know something smells wrong when solutions appear out of nowhere. Do me a favor. If you remember when handshake deals actually meant something in business, hit that subscribe button below. We're building something different here. No hype, no noise, just analysis. And before we go deeper, drop a comment. Where in the world are you watching this from? New York, London, Singapore, Mumbai? Let's see who's paying attention. Now, let's talk about what just happened to America's debt. In the summer of 2024, something unusual happened in the world's financial system. Nobody noticed. No headlines, no panic, no celebration, just a quiet shift in how money moved across borders. And it changed everything about America's debt problem. But to understand what happened, one must first understand the real number, $318 trillion. Most people hear about the $35 trillion federal debt. That number gets thrown around on news channels. Politicians argue about it. Economists write papers about it, but that's not the whole picture. The real obligation, the total debt structure holding up the American economy, is 9 times larger. Here's how it breaks down. $35 trillion in federal government debt. Another $3 trillion in state and local government obligations. Corporate America owes $13 trillion. Households carry another $17 trillion in mortgages, credit cards, student loans, and auto debt. Then comes the invisible part, unfunded liabilities, Social Security promises, Medicare commitments, government pensions, military benefits, $250 trillion in obligations that exist but have no funding source attached. Add it together, $318 trillion. That's 40 times the size of America's annual economic output. No country in history has ever carried this kind of weight. And here's the problem that keeps Treasury officials awake at night. This debt needs constant refinancing. Every year, trillions of dollars in bonds mature. They must be paid back or rolled over into new debt. That requires buyers, lots of buyers, foreign governments, central banks, investment funds. All of them need dollars to buy American debt. For decades, this system worked because the world ran on dollars. If China wanted to buy oil from Saudi Arabia, they needed dollars. If Germany wanted to buy electronics from Japan, they settled in dollars. The global economy was a giant dollar recycling machine. Countries earned dollars through trade. Then they used those dollars to buy U.S. Treasury bonds. America got cheap financing. The world got a stable reserve currency. Everyone played their part. But in 2020, China launched something different, the digital yuan, also called the ECNY. At first, analysts dismissed it. Just another digital payment system, China's version of Venmo or PayPal. Nothing to worry about. They were wrong. The digital yuan wasn't designed to compete with the dollar in the traditional sense. It wasn't trying to become the new global reserve currency. That's not how the game was being played. Instead, it did something more subtle. It created an alternative settlement system. Think of it like building a second highway system. The old dollar highway still exists, but now there's another route. And on this new route, transactions settle directly between central banks. No intermediaries, no correspondent banks, no dollar conversion needed. By 2024, the infrastructure was ready. China began testing cross-border settlements with Thailand, then the United Arab Emirates, then Brazil, then Russia. Small transactions at first, trade deals, commodity purchases, nothing dramatic. But something strange started happening in the U.S. Treasury market. The pressure eased, not because America's debt decreased, it didn't. The debt kept growing. But the refinancing stress, the constant need to find new buyers for maturing bonds, that pressure started to lift. Here's why. When countries trade with each other using digital yuan, they need fewer dollar reserves sitting in their central banks. Those dollars that would have been hoarded as insurance, they become available to buy U.S. Treasury bonds. It sounds backwards. A Chinese currency innovation helping America finance its debt? But that's exactly what the data showed. In late 2024, foreign demand for U.S. Treasuries stabilized, not because America became more creditworthy, not because the debt decreased, but because the global dollar squeeze, the constant scramble for greenbacks, began to ease. China had accidentally, or perhaps intentionally, created a release valve. The digital yuan pulled pressure off the dollar system just enough to keep America's debt machine running smoothly. Treasury officials saw the numbers. They understood what was happening, and they said nothing. Because what came next was the part nobody wanted to discuss. The relief was real, but the price hadn't been calculated yet. On March 14th, 2023, something happened in a Hong Kong data center that changed international finance forever. A Brazilian coffee exporter sold $3 million worth of beans to a Chinese importer. The transaction settled in 6 seconds. No SWIFT network, no correspondent banks in New York, no dollar conversion, no intermediary fees. Just a direct transfer of digital yuan from one central bank ledger to another. The coffee exporter received payment instantly. The Chinese buyer's account was debited. Done. This single transaction, buried in millions of daily trades, represented the death of an 80-year-old system. To understand why this matters for America's debt nightmare, one must first understand how money actually moves between countries. Most people think international payments are simple. Click a button, money moves, transaction complete. Reality is far messier. When a company in Brazil wants to pay a supplier in China, the money doesn't travel directly, it goes through a maze. First, the Brazilian real gets converted to US dollars at a local bank. Those dollars then travel through the SWIFT messaging system to a correspondent bank in New York. The New York bank verifies the transaction. Then it routes the dollars to another correspondent bank that has a relationship with Chinese banks. Finally, that bank converts the dollars to yuan and deposits them in China. The entire process takes 3 to 5 business days. Each step charges fees. Each conversion shaves off a percentage. Each intermediary takes a cut in every single transaction, regardless of whether it involves American companies or American products, requires dollars. This created something economists call structural dollar demand. Countries didn't hold dollars because they loved America. They held dollars because the plumbing of global trade required it, like keeping spare tires in a garage. You might never use them, but you need them available. By 2020, foreign central banks held over $7 trillion in reserves, just sitting there, waiting. Then China's digital yuan changed the architecture. The M-Bridge project, a collaboration between China, Thailand, UAE, and Hong Kong, built something radical, a platform where central banks could settle transactions directly with each other. No middlemen, no dollar conversions, no waiting days for clearance, digital yuan on one side, digital baht on the other, direct swap, instant settlement. In 2024, the platform processed its first $1 billion in cross-border trade. By early 2025, that number hit $50 billion. Saudi Arabia joined, Singapore came aboard, Indonesia began testing. Each country that plugged into the system reduced its dollar reserve requirements by an average of 12%. Here's where the mathematics get interesting for America's debt crisis. When central banks need fewer dollars for trade settlement, those excess dollars don't disappear. They flow somewhere. They flow into U.S. Treasury bonds. Think about it. A central bank holds $100 billion in reserves. Under the old system, it needed all of that for potential trade settlements. Under the new system, it only needs $70 billion. What happens to the extra $30 billion? It buys American debt. Not because the central bank suddenly trusts America more, not because U.S. fiscal policy improved, but because the money has nowhere else to go. The dollar is still the global reserve currency. Treasury bonds are still the safest, most liquid asset on earth. So excess dollars no longer needed for trade plumbing, automatically flow into U.S. government debt. This created an accidental subsidy. China built infrastructure to reduce dollar dependency, and inadvertently made it easier for America to finance its deficits. Between mid-2024 and early 2025, foreign holdings of U.S. Treasuries increased by $240 billion. Not because new buyers entered the market, but because existing holders had more spare capacity. Treasury Department analysts noticed the pattern in classified briefings. Refinancing costs were dropping, not dramatically, but measurably. The yield on 10-year Treasury bonds stabilized at levels lower than economic models predicted. Something was absorbing supply. That something was the unintended consequence of China's digital currency infrastructure. The Bank for International Settlements published a quiet research paper in October 2024. The title was technical and boring. The content was explosive. It showed that every 10% reduction in dollar settlement requirements freed up approximately $120 billion globally for alternative uses. Most of that money, roughly 70%, ended up in U.S. government bonds. China had built a system to escape dollar dominance, but in doing so, it temporarily reinforced the treasury market. The debt didn't shrink. America didn't become more solvent. The $318 trillion obligation still existed. But the immediate crisis, the refinancing squeeze that threatened to collapse, had been postponed. Financial strategists inside the Federal Reserve understood what was happening. They called it quantitative easing by proxy. China was inadvertently providing liquidity support to U.S. debt markets, without intending to, simply by changing how the global plumbing worked. It was the most elegant debt relief mechanism in modern history, and it came with a price tag nobody had calculated yet. Because while America enjoyed easier refinancing, China was building something else entirely, something hidden inside the code of every digital Yuan transaction. In a basement server room in Shenzhen, China, something remarkable was happening every second of every day. Data was flowing, not just transaction amounts, not just sender and receiver names, everything, every digital Yuan transaction, whether it was buying coffee in Bangkok or settling a $1 billion oil deal in Abu Dhabi, left a perfect digital fingerprint. Timestamps, location coordinates, product categories, buyer profiles, seller histories, payment patterns, connected transactions, 6 layers deep, all of it flowing into Chinese central bank servers in real time. And nobody outside China's financial intelligence network fully understood what was being built with that data. Here's what America's Treasury Department missed while celebrating easier debt refinancing. The digital yuan wasn't just a payment system, it was a surveillance architecture disguised as a currency. Traditional money is dumb. A dollar bill doesn't know who held it before you. It doesn't report where you spent it. It doesn't track what you bought. Cash is anonymous. Even electronic dollars moving through the banking system only leave scattered breadcrumbs. Digital currency is different. Programmable money knows everything, and whoever controls the infrastructure controls the information. By March 2025, over 40 countries had conducted test transactions using China's CBDC platforms. Each transaction created data exhaust. China now knew things no country in history had ever known about global trade flows. They knew exactly how much copper Chile was selling to Germany. They knew which Indonesian palm oil suppliers were working with, which European chocolate manufacturers. They knew the precise profit margins on Vietnamese textile exports to American retailers. They knew what Saudi Arabia was really paying for Chinese telecommunications equipment. They knew which African nations were stockpiling food reserves. They knew which South American mining companies were expanding production. Information asymmetry at a scale previously impossible. Here's where it gets dangerous for America's debt situation. Remember the relief mechanism? The extra dollars freed up by reduced settlement needs flowing into U.S. Treasury bonds? That entire dynamic depends on countries choosing to keep using dollars for reserve holdings. But what if they don't have to? What if the data China collects through digital yuan transactions gives them leverage to change the game? A historical parallel helps explain what's happening. In 1944, America gathered the world's financial powers at Bretton Woods. They built a system where dollars were backed by gold, and everyone else's currency was backed by dollars. For 27 years, that system worked. Then, in 1971, President Nixon did something unexpected. He broke the link between dollars and gold. Just ended it. Countries holding dollars screamed betrayal, but what could they do? The entire global trading system ran on American infrastructure. SWIFT was based in Belgium but operated under U.S. rules. Correspondent banking networks flowed through New York. There was no alternative. So the world kept using dollars, not because they wanted to, because they had no choice. China studied that history carefully. They're not trying to repeat America's mistake of announcing dominance. They're doing something smarter, building the alternative infrastructure first. The digital yuan settlement networks create optionality. Countries don't have to abandon dollars immediately. They can run both systems in parallel. Dollar transactions for some trades, digital yuan for others. But here's the trap. Every transaction that shifts to the digital yuan system gives China more data, more insight into global supply chains, more leverage over trade relationships. And slowly, the balance of power shifts, not through military force, not through debt traps, through information advantage. There's another element most analysts overlooked: programmability. Digital yuan transactions can carry smart contracts, conditional settlement terms written directly into the currency code. Imagine China selling machinery to Nigeria. The payment settles in digital yuan, but with embedded conditions. The money only releases when the machinery arrives at the destination, or when certain performance benchmarks are met, or when Nigeria agrees to specific trade terms with Chinese partners. Programmable money creates programmable leverage, and once that leverage exists, the friendly debt relief America is experiencing becomes something else entirely. An intelligence assessment circulated quietly through the U.S. National Security Council in January 2025. The conclusion was stark. America's improved debt refinancing wasn't relief. It was the early stage of dependency transfer. Like a patient given morphine for pain, the pain decreases, the patient feels better, but the underlying disease progresses untreated, and now there's addiction to manage. The dollars flowing into Treasury bonds because of reduced settlement pressure, those flows could reverse instantly. If China decides to offer settlement incentives that pull more transactions onto digital yuan rails, dollar reserve needs drop further. Suddenly, those Treasury bond purchases stop. Or worse, reverse. The $318 trillion debt doesn't care about geopolitics. It only cares about finding buyers. And if those buyers gain leverage through information asymmetry, they stop being passive investors. They become strategic actors. The most chilling part? The window of American advantage was already closing. Every month, more trade shifted to alternative settlement systems. Every quarter, China's data advantage deepened. Every year, the strategic dependency grew. The debt relief was real. But it was temporary. And the price was still being calculated in server rooms in Shenzhen. While American business leaders watched Treasury yields and celebrated stable markets, the foundation of economic sovereignty was quietly shifting beneath their feet. The question wasn't whether this would impact business. The question was whether anyone would recognize the impact before it was too late to adapt. November 2024, a mid-sized electronics manufacturer in Austin, Texas, received an unusual email from their largest supplier in Shenzhen. The subject line read, "New payment options available. The Chinese supplier offered a 12% discount on all future orders. If the American company agreed to settle invoices in digital yuan instead of US dollars, 12%. On a $20 million annual supply contract, that's $2.4 million in immediate savings." The CFO stared at the proposal for 3 days. Accept the discount and navigate an unfamiliar currency system, or stick with dollars and watch competitors who take the deal undercut their pricing? This wasn't a hypothetical scenario. It was happening to thousands of businesses across America, and most of them had no framework for making the decision. Here's what business leaders need to understand about the emerging reality: the macroeconomic shifts, the debt dynamics, the geopolitical currency games. Those aren't abstract concepts reserved for economists and policymakers. They're landing directly on corporate balance sheets. Right now, companies operating in international trade are facing a choice that didn't exist 18 months ago. Stay entirely in the dollar system, or build capability to operate across multiple settlement infrastructures. And that choice comes with immediate financial implications. Let's break down what's actually happening at the enterprise level. Corporate treasury departments are designed around dollar optimization, cash management systems, hedging strategies, credit facilities, foreign exchange risk models. Everything assumes dollars as the anchor currency, but when suppliers start offering significant discounts for digital yuan settlement, that assumption breaks. A company accepting digital yuan payments faces new questions. Where do we hold these yuan? Which banks can custody digital currency issued by a foreign central bank? How do we convert back to dollars when needed? What's the tax treatment? How do we hedge currency risk on an asset that doesn't have deep futures markets yet? Most mid-sized companies don't have answers. The largest corporations, the Fortune 500 firms with sophisticated treasury operations, they're already building experimental frameworks. JP Morgan has teams exploring multi-CBDC settlement. Citigroup is testing digital yuan custody solutions for corporate clients. But for the vast majority of businesses, those with annual revenues between $10 million and $1 billion, this is uncharted territory. Here's where strategic positioning becomes critical. The companies that move first gain advantage, not by going all in on digital yuan. That's reckless. The regulatory framework is unclear. The long-term geopolitical risks are real. But by building optionality, smart treasurers are doing 3 things right now. First, they're establishing relationships with banks that have digital currency infrastructure. Even if they don't transact in digital yuan today, having the capability ready matters. When a crucial supplier offers that 12% discount, they can move quickly instead of spending 6 months setting up systems while competitors capture the savings. Second, they're stress testing supply chains for currency concentration risk. If 80% of your suppliers only accept dollars and dollar liquidity tightens, you have a problem. Diversifying settlement capability creates resilience. Third, they're watching the data flows. This is the subtle piece most companies miss. Every transaction on China's digital yuan infrastructure creates information leakage. Purchase volumes, timing patterns, supplier relationships, pricing structures. Companies need to assess what competitive intelligence they're potentially exposing and decide if the cost savings justify the information asymmetry. Sector-specific implications are already emerging. Manufacturing companies with complex Asian supply chains face the most immediate pressure. Their suppliers are offering the steepest discounts for digital yuan settlement because it eliminates their own currency conversion costs. An automotive parts manufacturer in Michigan calculated that switching 30% of Chinese supplier payments to digital yuan would save $4.2 million annually in both discounts and reduced FX transaction fees. But it would also expose their entire supplier network structure to potential analysis by Chinese financial intelligence systems. The company is still deciding. Technology companies face a different calculus. Many tech firms already operate in China through complex corporate structures. They're accustomed to navigating dual regulatory environments. For them, adding digital yuan settlement capability is less disruptive. Several Silicon Valley firms have quietly begun accepting digital yuan for certain B2B transactions with Asian clients, not as primary settlement, but as an option. They're building the muscle memory now, while the stakes are relatively low. Commodity traders are moving fastest: oil, copper, lithium, soybeans. These markets are already seeing significant digital yuan settlement activity. Chinese buyers represent such large portions of global commodity demand that sellers have limited negotiating power. If China offers a premium for digital yuan settlement, sellers adapt or lose market share. A Brazilian soybean exporter told industry analysts in December 2024 that roughly 18% of their Chinese sales now settle in digital yuan, not because they prefer it, because the alternative was watching Chinese buyers shift to competitors willing to accommodate the payment preference. For small and medium enterprises, the challenge is more fundamental. Most SMEs lack the treasury sophistication to manage multi-currency operations. They don't have teams of financial analysts. They don't have relationships with major international banks. But they're competing against companies that do. If a competitor figures out how to capture those digital yuan discounts, they gain a cost advantage that smaller players can't match. This creates a strategic fork in the road. Some SMEs will need to form consortiums, pooling resources to access shared digital currency infrastructure. Industry associations are beginning to explore this model. Others will need to specialize in all-dollar supply chains, accepting potentially higher costs in exchange for operational simplicity. Both paths are viable. But ignoring the choice, that's not viable. Here's the timeline that matters for business planning. Between now and late 2026, this remains optional for most American companies. Digital yuan settlement is an opportunity, not a requirement. Between 2027 and 2029, optionality hardens into strategic necessity for trade-intensive sectors. Companies without multi-settlement capability will face measurable competitive disadvantage. After 2030, the landscape becomes unpredictable. It depends on how aggressively China leverages its infrastructure advantage and how effectively America responds with alternative systems. The business leaders who understand this aren't panicking. They're building capability quietly, testing small transactions, training treasury teams, establishing banking relationships, monitoring regulatory developments. They're treating this like any other major infrastructure shift. When email replaced faxes, companies that adopted early gained advantage. When cloud computing emerged, early movers captured efficiency gains. This is the same pattern, just with higher stakes. Because this time, the infrastructure shift isn't just about efficiency. It's about economic sovereignty. And the companies that position correctly won't just survive the transition. They'll define what comes next.